Japanese candlesticks are among the most vital tools in Forex trading. They provide a visual representation of price action, helping traders identify potential reversals, continuations, and momentum in the market. These candlesticks have been used for centuries, originating from Japanese rice traders, and today they remain one of the most popular forms of technical analysis. Understanding their anatomy can give you the upper hand in executing successful trades. At K9 Investments, we believe in breaking down complex trading concepts into easy-to-understand insights. In this article, we'll dissect the anatomy of Japanese candlesticks and explore how you can use them to interpret market behavior, enhance your trading strategy, and spot potential profit opportunities. Japanese candlesticks visually represent price movements over a specific period. Each candlestick displays 4 key price points: the open, high, low, and close of the asset during a particular time frame, whether it's 1 minute, 1 hour, or 1 day. This gives traders a complete snapshot of market activity, making it easier to predict future price movements. Let's break down the key components of a Japanese candlestick into 2 primary parts: the body and the shadows. The body of a candlestick represents the range between the open and close prices during a specific period. Long candlestick bodies indicate strong market momentum. Short candlestick bodies suggest indecision or a lack of momentum. A hammer occurs when a candlestick has a small body and a long lower shadow. A shooting star is the opposite of the hammer. Candlestick patterns give traders a deep insight into market sentiment and potential price movements. But how do you apply this knowledge to your Forex trades? Understanding the anatomy of Japanese candlesticks is crucial for every Forex trader. By learning how to interpret candlestick bodies and shadows, you'll be better equipped to make informed decisions and identify market trends.